So if you've been trading in the markets, you've definitely heard the term liquidity, right? But a lot of people don't understand what that really means. They understand maybe the concept in price. Maybe they can identify levels of liquidity on a chart. But what really is liquidity? So liquidity refers to a financial market where assets can be quickly bought or sold without causing significant impact on their prices. So what that means for the market, it means that you have the ability to enter and exit a trade whenever you want to any second of the day, right? Given the market is open. Now, market makers and big hedge funds are often referred to as liquidity providers. This means they're the ones buying the other side of your sells and they're selling the other side of your buy orders. Each market has a designated market maker on the New York Stock Exchange whose job is to provide a fair and orderly market, right? And that kind of leans into fair value gaps and order blocks, which we'll dive into shortly. But today is solely based on liquidity. So now we know what a liquid market is, and we know who provides the liquidity. But why is liquidity important to the market makers in terms of where price is going to move? Well, market makers essentially control price movement, right? If they're ensuring fair and orderly markets, that means they're manipulating the price for fair value, right? And to keep the market orderly. So they have the ability to move price up and they have the ability to move price down, right? And when they're buying the other sides of our trades, they're eventually going to end up in a net long or net short position. It's just inevitable. The market can't stay stagnant. It has to move up, it has to move down, and liquidity has to be provided by smart money. Now, if we see a big rally higher, for example, in the first 30 minutes of the morning, if we have our AM session Judah swing, if you're buying and buying and buying and retail is buying and buying and buying and flying the price higher, someone has to be on the other side of those buy orders, and that's smart money. Every time you press that buy button, they're the ones selling that to you, and they're essentially getting short. And eventually, once you hit that 30 minutes into the market, smart money is net short, they'll typically reverse price and send it lower towards liquidity in order to offload their positions where orders are already resting. So why do they want to move it towards liquidity and not just offload it anywhere in their market? Well, it's because they have to, right? When you're a liquidity provider, you're holding tens and tens and maybe even hundreds of thousands of contracts at any given time, right? Even in just 1 minute, 5 minute charts, you know, with these high frequency trading algorithms. So you can't just market buy or market sell when you are the market maker. Instead, what they do is they manipulate price to these areas on the chart where retail already has limit orders, whether that be in the form of stop losses, breakout limit orders. That is where they're going to move the market in order to offload their positions because they have such a strong number of positions on, they have to go where the orders are already resting. If we go into market replay mode real quick, and we just take this to about here. Well, where's the liquidity resting here? Well, we have a low here, a low here, and a low here, and another equal low here, right? So a quick lesson on how big funds do technical analysis, right? They do their analysis on the monthly chart, the weekly chart, and they do their executions on the daily chart. So when you're trading these markets intraday, you're not going to jump out and say, oh, there's probably stop losses down here, right? Because this was, you know, God knows how many days ago. But these big funds, these are the positions that they're in. This is what they're taking, and this is where their stop losses are. And who do you think is going to have the most open interest in these markets? It's probably going to be the big funds, right? They're trading hundreds of thousands of contracts. So if the market makers have the ability to take the market lower, because if you see this big run higher, they're the ones selling short, right? So smart money is net short. In order to offload their positions in a profit, they have to redirect the market lower, and they're going to be seeking an area of fair value, right? That's one of their jobs, fair value, and an orderly market. So in order to efficiently provide the market to both buyers and sellers, the price is going to have to draw to an imbalance, and on the way down to those imbalances, you're going to be seeing it run for internal and external liquidity. So what is internal liquidity and what is external liquidity? Well, if you look at a trading range, we can come out of market replay mode to make this a little bit easier. So if you take this trading range right here, for example, we have internal liquidity here. You see these highs here, right? There's going to be stop losses resting there. And we have these relative equal highs right here, where again, stop losses are going to be resting. This would be our external liquidity because it is at the high of the trading range. And then you have these relative equal lows right here, which is the low of this trading range. And I'm basing this trading range off of this initial consolidation with these two relative equal lows just after this displacement higher. So we're taking the market from a premium into a discount where smart money can offload their positions in a profit. So I'm going to change this color to red to identify this as internal liquidity. And you can see if we take this off, so we have a high here and our two relative equal highs here. So what does the market draw to? Well, we have internal liquidity here and here, right? So we took internal liquidity on the buy side of the curve and we left this behind. So now we reverse, form one more relative equal high, have an extreme engulfing candle here, and this is meant to catch retail offsides, right? They now see this as a level of resistance, and this is where they're going to trail their stop losses. You have a very strong reaction off of this level, and immediately you can see the market makers turn around and take them out of the market. It sweeps this liquidity and this liquidity. Now we have no more internal liquidity left. So what does that mean for the market maker? Where are the orders now? Well, everyone who is long here, they've been taken out of the market. Everyone who is short from here, and here, and here, they've all been taken out of the market. So where are the orders resting now? Now we're going to be running for external liquidity, and that's going to be the final stage. So we come up, and we have this fair value gap right here. After sweeping liquidity, we come up to consequent encroachment of this fair value gap. We have our consolidation. And when this consolidation breaks, we go straight towards this external liquidity, right? You can see we wicked through it right here, came back up to an area of fair value one more time, wicked through it again, and now what are we taking, right? We didn't dip all the way into this area of fair value, and this is kind of going outside the scope of liquidity here if you don't know too much about fair value, why price draws there. After dipping into this a little bit, we come back up, make one more run on our internal liquidity here. We use this inversion fair value gap. Notice how the bodies are respecting the consequent encroachment of that. That's a good sign. And then immediately we have that huge run lower right into our final objective of this area of fair value. And then you can see we get the displacement higher and we begin running for all of this liquidity right here. So now you know how market makers are moving the market to internal and external liquidity and bouncing between the two, right? So now we're going to go over how to identify the draw on liquidity. So if we just drop into a lower time frame, so now we're looking at an hourly chart of that same area on the NASDAQ, except now you can't really see too much because of how far out we're expanded. But what this does do is it makes it very easy to spot where the liquidity is resting. Now, when you're spotting liquidity, you want to be thinking in terms of the market maker and the retail trader. So what does that really mean? Well, first you want to identify where stop losses would be if you were a retail trader. Where do the books tell you to trail your stop losses? Where do the books tell you to place your breakout orders, right? Equal highs and equal lows, because that is support and resistance. And that's the logic that retail traders use. And that is the mindset that market makers and smart money are going into the market with to counter. So they're going to be hunting down these retail orders. So if we just zoom into this range right here, I'll show you exactly what I mean by that. So look at this range here. We have a large area of fair value up here. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 relative equal highs right here. So if you get short here and you see this big and energetic move lower, big institutions and retail traders who are in long-term positions are going to trail their stop losses above these highs, right? This is the highest high of that consolidation. Some people are going to have their orders above these highs, but this general area right here is our pool of liquidity. This is where the orders are going to be resting, and this is where the market makers are going to move the market to. This orange box right here is where all the retail orders are, and you can see how smart money is selling and selling and selling and selling, and they need to offload their short positions in a profit because that's what they do. They hedge their positions, meaning they can be in drawdown for a pretty long amount of time, but eventually they will always move the market in their direction in order to offload at either break even or a profit. So now that we've identified where these stop losses are, we can remove this orange box of liquidity here. Now this red line is the best case scenario, right? This is the highest high of this liquidity, which usually gets taken, but I like to play it safe, and I like to go for kind of the center, right, where the most highs are, as in, where the most clear retail idea of support or resistance would be, because that's where the majority of orders are resting. Now, this is the part where a lot of people get lost, because they don't understand the true definition of a liquid market and why the market moves to liquidity like you just learned. It doesn't need to take out the highest high of the liquidity. All it needs is to move the market in the area where the orders are. So all the orders aren't going to be up here. There's going to be orders here and 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 up in here, right? You could see in this scenario, we did come up and we did take these two relative equal highs, but not by much. You could see the majority of the accumulation period, or this consolidation, was right where this one was, because that's where the majority of orders are, and they have one final send higher to take out those last highs in this area of fair value before dumping the market lower. So now that you know how to spot liquidity, we're going to figure out how the market is going to move to liquidity. So now you're probably thinking, how do you know we're not just going to take this liquidity and continue our move lower? Why didn't we continue our move lower right here when we have these relative equal lows and we dug into this area of fair value and have already taken internal liquidity? Well, that's because we have one more area of internal liquidity. Remember what I said earlier, we move from internal to external. So if we zoom out on our chart, we have internal liquidity resting here. That's taken. We come up, internal liquidity here. We take that, come back down one more time, form our intermediate term low, and we finish up taking out that internal liquidity on the buy side. So now what are we going to run for? We're going to run for sell side. We have these relative equal lows here. So we get our initial consolidation, our expansion lower, and we take out that level of internal liquidity. The market then reverses, internal liquidity here, internal liquidity here. We come up, take out all of this liquidity here, and that's when we can continue our move lower. And what do we run for? Well, we run for that external liquidity that we'd spoke about earlier into our area of fair value. Now these examples are all on a daily chart and an hourly chart, but this works on every single time frame. We can even dip down into a 5-minute chart, and you can see how the market continuously draws to liquidity. So this right here is a great example of how the market makers will utilize liquidity intraday. I'm going to put a vertical line here on our 9:30 New York Open, and you can see, like I mentioned earlier, we have that first 30 minutes right here. Right? You can see in the first 30 minutes, we expand and move price higher, and it's just a series of up-close candles. You could see retail is buying, smart money is sending price higher to liquidity. Equal high here, 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 and you can see where all of the orders are resting clear as day. If you got short and you think the move is going to continue down because we've had all of this, your stop loss is likely going to be trailed right here for short-term traders. Since we're on a smaller time frame, we're thinking on a shorter term basis with our long-term bias in mind as our overall daily direction. So when the market opens, we sweep our internal liquidity inside of this trading range from this high to this low. After we sweep our internal liquidity with our 9:30 New York Stock Exchange Judas swing, the market makers are now short retail. What this means is retail continued to buy, and the market maker, as the liquidity provider, is selling every time retail presses buy, because in order to buy something, you have to have someone selling it. So we dig into this area of liquidity, and now smart money is short retail. They're net short. They have a net short position on. They're making money as the stock moves lower, and they're losing money as it goes higher. So what they do now is they reverse price, and they send it to our external liquidity. This is outside of our previous trading range, and we do have relative equal lows built up right here. You can see that when 9:30 hits, we come down, we come back up one more time to this bearish order block, ensuring an orderly market, and price gets sent directly through our external liquidity. And if you zoom in on a lower time frame, I'm sure you're going to find the 2022 model and the silver bullet here as well. So this is a 3-minute chart. Right here we have our shift in market structure, our return to a fair value gap, and our run through liquidity, right? This is your silver bullet. Right here is your model 2022 entry, right? So right here we have our shift in market structure, right? A clear and pronounced shift in market structure. We have our return to our fair value gap after displacement lower. And then we immediately run for our external liquidity right here. And that is your silver bullet. If you look closely, you can see that we have a bearish order block resting right here. On a lower time frame, we have a shift in structure. We return to that bearish order block, and that propels price lower before forming your higher probability silver bullet entry. So just to make a recap, we have our external liquidity in the high and as well as the low of our trading range. Our internal liquidity is all of the relative equal highs on the inside of our trading range, right? So we have liquidity resting here as internal, and we have liquidity resting here as internal. So you know where price is going to draw now, and you know how it's going to get there and in what order, right? We have a high, and equal highs here. People who got short here are going to trail their stops to these equal highs because they see that as a level of resistance. People who got short here are again going to trail their stop losses from here to here in their net short positions, because this again is viewed as a level of resistance and willing to propel price lower, and we know that's not the case, and that's going to be our buy side curve target. So you see we have our sell side curve and our buy side curve. After our smart money reversal, we come up, we take out our first area of internal liquidity right here. We move up, we take out this internal liquidity here, right? We can expect a retracement to an area of fair value, an order block, something like that. While on a lower time frame, we're also taking out this liquidity here. We propel price higher one more time, take out this internal liquidity here. So now we've taken out all of the sell side curve liquidity. So what's next? Well, let's look at this consolidation. Was this taken care of? Our internal liquidity here has been swept. After sweeping this, we have another low right here. So we can come down, take them out of the market here, or build another equal low to revisit at a later time. So if you look at the sell side of the curve, we have now efficiently taken every single area of internal liquidity, which means our next big draw on price is going to be our external liquidity at the high of the trading range. Once that is satisfied like it is right here, and you are bearish on a long-term basis, what you can then expect is for price to have some sort of smart money reversal and continue its run on liquidity here. Just taking these out one at a time, right? Liquidity here, internal, liquidity here, internal, and then we have our external liquidity down here, which would be our final target. And if you look at this, it looks like pretty normal market structure. You have a downtrend, an uptrend, and a downtrend, or whatever you would like to call it, right? What I see here is I see a market maker model. I see a market maker buy model, right? And you can see how that transitions into a market maker sell model and how that's just drawing in between buy side and sell side liquidity, which is a model I really like using and something that we will definitely cover in the future. But that'll do it for the liquidity video. If you have any questions, leave them below and I will be happy to answer them. And we're going to continue building these fundamentals of ICT before we get into real technical entry models so that you have a good understanding of the context of the market and where the market is going to go independently without an analyst, without needing any kind of validation for your own analysis. With that being said, stay safe. Until next time.